So now we want to go to, this is why in the textbook you see this diagram called dividends, interest and royalties. I just explained to you how you can manipulate interest, how you can manipulate royalties. Starbucks does that. And then thin capitalisation. So no wonder why now the countries in the OECD, they come together and say, oh, we're going to start imposing withholding taxes on dividends and interest and royalties. Like, look, Australia, 30, 10 and 30. Okay, is USA here? 30, 30 and 30. Wow. Like, you know, they're really not much you can do to use these tools to move income around between entities in and out of the US. Okay, Singapore, 0, 15, 10. So Singapore is saying, well, you can pay dividends out of subsidiaries. We're not going to have withholding tax on that. By the way, withholding taxes also, if you play it right, we're going to show you an example later, you can get tax credits on withholding taxes. Okay, which is the second part of the chapter. You can get tax credits. It's just that companies make it very, very clear, we're going to take money away from you and you can work out how much you owe us later. You with me? Withholding tax is boom. They're not waiting for you to do your tax return. Oh, you're remitting this? Bang, we take this percentage out immediately. Okay? And whether we give it back to you later as a credit or not, we'll work that out later. Okay? Because we may not see you again. We may not see you again. You might leave the country and not come back again. You see, to file your return and do the honest thing. Okay, so that's what we mean by withholding taxes. It's not an extra penalty. Okay. All right. In Australia, when you earn a salary, they take money out each week, each month. You get your salary. In Hong Kong, they don't take the money out. They wait until the end of the tax term, right? So withholding tax is like a pay-as-you-go system. Okay, so let's keep moving on that. Let's keep going here. All right, so that finishes our tax planning strategy I want to take you through. There is a short segment on value-adding tax I want to take you through now, then we'll have a short break. But with tax planning strategy, I'll leave it to a little bit later to look at dividends, because dividends is a different animal. Dividends is the after-tax remittance of money from one entity to another. Are you with me? So it's dividends is not the payment of dividends is not a tax planning strategy. It may be part of the tax planning strategy to not pay dividends, but as you'll learn in the second part of the chapter, the US have laws set up to make whatever's in your income earned for the period a deemed dividend if you are a certain type of company. So even if you don't pay a dividend, the US law will say, oh, you've paid a dividend because you've earned the money. Because you are in a tax haven, because it's passive income, it's not manufacturing, you're not making anything, you're not creating any value, you're providing services or something like that. Okay, but that's the second part of the chapter.